when it comes to choosing a rental property to invest in, there are several layers to the rental property that you should definitely know about before actually buying it. In this video, I have categorized the most important layers into three main groups to keep it as simple as possible. The first is the type of the rental property. The second is the location of the rental property. And finally, the third is the financials of the rental property. Let's start off with the type of rental properties. When it comes to rentals, there are only two important categories that rental properties generally categorize under. That is residential rentals and commercial rentals. So residential rentals simply refers to every property that's rented out for people to live in. And that could be literally anything, starting from single family homes, multiple family residentials, duplexes, triplexes, quadplexes, to even condos at this point. Any of these units, when used as student or senior housing, is considered to be residential rental properties. Speaking of which, honestly, you should know that all residential rental types, student and senior housing, tend to have stronger and steadier rental income through all phases of the economic cycle, including a recession. The logic is very simple. Students will always need a place to live in when attending school, unless, of course, universities start doing full-time online classes. So the demand for student housing will pretty much be stable throughout. As for senior housing, well, the aging population globally has been at an all-time high and is also expected to keep rising in the future as well. So at least for the foreseeable future, the demand for senior housing is likely to be prevalent regardless of whether there's a recession or not. In other words, it's really to say that senior housing can also be considered as one of the greatest income generating property types under residentials. Then if you take commercial rentals, they are any property used for business activities. So office spaces which range from single-story buildings, suburban Class C buildings to Class A urban skyscrapers. There's retail spaces which could be anything from malls to business outlets. There's grocery stores, rentals that are put to industrial use like warehouses, distribution centers, properties that have commercial lodgings like hotels, Airbnbs, resorts, holiday homes, self-storing units, and other units like cell towers and even farmlands. They are all properties that fall under commercial rentals. Now, all these properties like farmlands and warehouses and distribution centers and self-storing units have shown tendencies to outperform the negative effects of recessions. For example, if you take farmlands, recession or not, people will still need food to eat. So the cultivation harvests will still continue to happen. It is highly, highly unlikely for demand for important food ingredients like, say, wheat or corn to decline, leading the farmland tenant just to give up because there's a recession. It's a slightly similar rationale when it applies to, say, warehouses and distribution centers. Whatever a business produces, it will need a space to store these goods and to organize and then distribute them. Now, with the increasing number of online delivery services, the need will only, if ever, increase. So there's a fair chance that units like this will continue to perform well even through a downturn. As for self-storage, when recessions hit an economy and people and businesses start to experience the negative effects of it, they tend to give up on any extra spaces that they might have to cut down on the costs. And whatever they had extra spaces for, or rather in, will be moved to these low-cost self-storing units. So again, these are also likely to perform well during a recession. In fact, when the real estate market was practically bleeding during the 2008 recession, self-storage facilities were the only real estate type that was making positive earnings. Now, As opposed to all these types, there are also certain types of properties that particularly perform badly during a recession. The first and most obvious type is commercial lodging, like hotels, resorts, and holiday homes. As you may have already guessed, the demand for vacation type properties is the first to drop during a recession when people travel and spend a lot less. The same can be said for businesses like travel as well. So these classes of properties are real estate that you should steer clear away from if you're aiming to have a stable stream of income. So apart from commercial lodging, the other type of property that is seeming to lose its hype is retail properties like showroom outlets and grocery stores. This decline is more to do with the increasing demand of people tending to shop online rather than the recession itself. I mean, people are shifting from going to physical stores in person to shopping online, meaning there's now a trend of decline demand anyway. This is just amplified when a recession happens, making it much, much worse. So again, retail properties are quite risky to invest in. Now, let's move to the next criteria that you need to analyze a property by, and that is the location. Now, I don't know if this seems very minute, but the location of a property is one of the most important factors that determines the profitability in real estate investing. Because at times, more than the property itself, the location of it tends to be the main reason of high demand for that particular property that allows for an investor to charge higher rents. So location is absolutely, absolutely important. Now, even with location, what you should check on will vary depending on whether you're looking to buy a residential property or a commercial property. For example, if you take residential properties, you can check on its connectivity as a start. Ideally, a property with a good location should be close to, let's say, public transport hubs like bus stands and metros and train stations. The more closer the property is, the more rent you can charge. And the further it is, vice versa, you have to keep lowering the rent. Another element you can check on is the property's proximity to essential social infrastructural institutes like good schools, good universities, hospitals, shopping malls, movie theaters, and places of that sorts. Properties with close proximity to these kind of facilities tend to have more residential value. One other thing to check on is the infrastructural developments at that location. So that is to say that if a specific area is going to have some major developmental projects like building roads or bridges or metro stations coming in, commercial centers or any facility that we just discussed, there is a very, very high tendency for the economic value of that area to almost skyrocket in the next or the few upcoming years. So if you can find a property in such an area and get it ready for when the projects are being implemented or being completed, you can charge a very high premium rental and earn substantially great returns. Apart from all these, another important thing for residential properties to have in terms of its location is a good neighborhood. The rent you charge is also influenced by the neighborhood. That is to say, a good neighborhood and you can charge a high rent. A bad one, and then the rent will have to be lower. Now, if you take commercial properties, the locational elements that matter are pretty much the same as residential properties. But you'll also have to take a slightly varied or different approach within each element when you're analyzing locations for a commercial property. For example, the connectivity and the infrastructural landscape are very important for commercial properties as much as it is for residential properties. But as opposed to residential properties, commercial properties will also have to have close proximities to motorways, to airports, to huge arterial roads, in addition to public transport hubs, Because say a business that occupies a property or that particular property will need to have access to logistical convenience to transport their goods and anything else thereby. So a property that is close to all these infrastructural and logistical facilities will be able to charge a much higher rent compared to those with no such facilities. Then the tenants of commercial properties generally look to have close proximities to auxiliary service providers like banks, post offices, or say hospitals, so that if the need rises, the services are all within reach. So that's another thing you can check on. One more thing that makes the location attractive for commercial properties is the area, or at least area-specific regulations. If an area for some reason has tax exemptions, that becomes a great business advantage for many, many businesses. The demand for properties in such locations will always be higher, and thus a higher rent can also be charged. Now, residential or commercial, it's not just about charging a higher rent. It's also about having a consistent demand from tenants. As far as there is demand, the vacancy rate rather of the properties will be low, allowing for a steady stream of income. That's what makes the locational aspect of a property almost the most crucial driver for demand. Now, moving on, the third factor, which is the financials of the property, is another very, very crucial part that should be analyzed before investing in a particular property. Let me go over some of the elements that you need to pay special attention to when crunching numbers for a rental property that you might be interested to invest in. So first and foremost, the thing you need to figure out is the potential income and expenses of the property. Now, by income, you have the most obvious, which is the rental income. And on top of that, there might be other forms of income that you might be able to earn, like additional amenities charges for, say, parking fees. So you need to take all that into consideration when you are projecting an income. So you do also note that when you're accounting for these incomes, you can't assume that your property will be given for rent throughout the year. Being fully occupied, although is dreamlike and ideal, is not perfectly practical. Therefore, you need to discount a small part of your income for vacancies. The percentage rate for the vacancies will depend absolutely on the type of property and the location of the property. You'll need to do some research on your own to determine an exact number depending on where and which properties you seem to be interested in. But on average, the vacancy rate is set to be somewhere between, I think, 3 and 5%. And during recessions, these numbers tend to shoot up quite a bit. Now, as for expenses, you will need to analyze every single expense the property will entail. That is, if you've taken a mortgage loan to buy property, then the mortgage interest, if there are any repairs or maintenance, property management expenses, any associated taxes, property insurance, there's utility payments, then there's depreciating costs, and every single expense that you think the property will possibly entail will have to be included in your projections. And now, once you crunch the numbers on the property's potential income and expenses, you can then comfortably calculate the net operating income, or the NOI, of that particular property. All you have to do is deduct the total expenses you have calculated from the total income. Calculating potential NOI for a rental property is one of the most crucial steps in financial analysis, because the NOI is what shows you how much returns you can make from a specific rental property. And that figure will therefore tell you if that investment is worth after all. This then brings us to another critical calculation you will need to make, and that is the capitalization rate, or the cap rate. In real estate, the cap rate refers to when the NOI is seen as a percentage of the investments that is made on the property. So, for example, if you buy a property for $200,000, right, and you calculate that property to have an annual NOI of $10,000, then the cap rate of that property would be 5%. So cap rate is basically NOI generated by the property divided by the value of the property into 100. And theoretically, the higher the cap rate, the higher the returns are. The lower the cap rate, the lower the returns are. So the goal should be to find a property with a reasonably high cap rate. With NOI and cap rate, you can now have a reasonable idea on how the property is bound to perform financially. Now, the seller or the seller's real estate agent generally releases the property's past and projected financial figures. This includes the income expenses, the NOI, the cap rates, etc. to interested buyers, meaning you're likely to receive all these figures from the selling party itself. Now, I understand if you wonder why then you should do your own numbers. That's because the seller or the real estate agent generally tends to mess with the numbers, where they use higher rents and lower expenses to show better financial performance. The better these numbers are, the higher the rate they can sell the property for, isn't it? So they will overinflate all of it. But the thing is, if the financials of the property were so good, there won't be any reason for them to sell the property to you in the first place. So you need to be very mindful of these real estate games. And one way of being mindful is by calculating everything on your own from scratch. That way you can verify the numbers given by the seller and compare your figures to the seller's figures to see if that even makes sense. Now, to help you with this part, and as part of the next lesson, we have given a very, very comprehensive reading material from Eric Tyson and Robert S. Griswold's book, Real Estate Investing for Dummies. The material is the 12th chapter of the book, which is a complete guide onto how to develop your own financials for a property. The read is quite long, but that's because it's thoroughly detailed. So do have a read without skipping it. 3 important factors that should be analyzed when interested in a property: the type of the property, the location of the property, and finally, the financials of the property. So to help with this analysis, Michel Sean, in his book Investing 101 from Stocks and Bonds to ETFs and IPOs, an essential primer on building a profitable portfolio, has outlined a list of questions that an investor should ask before investing in a real estate property, especially if the investment is done with the aim of earning a return. This extract has been given to you as additional reading material in lesson 10.6. Do have a read of that as well.